Hi, I'm Natalie MacDonald bringing you one of the big stories of the day. The Bank of England have opted to leave interest rates and asset purchases unchanged today. This news comes a day after Chancellor of the Exchequer George Osborne slashed taxes and extended austerity. On the phone with me now is Andrew Goodwin of Ernst Young's ITEM Club. Andrew, this decision was largely predicted, but can you talk us through the rationale behind the BOE's choice?
I think the BOE's decision was largely expected, mainly because were it going to move, it would have done so last month to coincide with the inflation reports. I think since then, not enough has really happened in terms of the economic outlook. We're still looking at a very slow grind towards recovery. And I think that really sort of the thing that clinched it sort of last month and that was still a bit of a factor this month was the Treasury's decision to repatriate the proceeds from QE. The bank saw this as being tantamount to doing QE itself, and therefore I think it felt really it didn't need to do anything either last month or this month.
Recent MPC minutes, as well as public statements from MPC members, have indicated continued trust in the Funding for Lending scheme and its ability to boost credit growth and overall activity in the UK. Yet we are receiving conflicting data as to the success of this scheme. Is it still too early to tell the effectiveness of this policy? And if so, when are we likely to see results?
We've had the first data on funding for lending this week, and that's data for the third quarter. So that's really the first 2 months of the funding for lending scheme, and that was quite disappointing in terms of the amount of extra lending it generated. But I think that is probably too early for it to really have an impact. Certainly, those figures suggested that though a lot of the banks have indicated their interest, not many of them actually used the facility in that time. So I think we're really going to be looking at the fourth quarter and even into the first quarter of next year before we start to see some sort of pickup. The bank itself are very bullish about the prospects of funding for lending. We're also reasonably upbeat about it as well. Certainly, I think in terms of what it will do for the supply of lending, the big question mark for us is whether the demand is there. I think it's all well and good putting forward this increase in the availability of credit, particularly for mortgage lending, but it's far from certain that the demand is going to be there to actually soak up that extra availability. And I think that's what we'll be looking for over the next couple of quarters.
George Osborne yesterday extended his austerity programme until 2018, admitting that Britain's malfunctioning economy has left him unable to meet the government's targets for repairing the public finances. Critics have used this as a sign that current measures simply aren't working. Is this the case?
I think certainly the progress has been a lot slower on the fiscal side than the Chancellor would have hoped. But we attribute that really directly to the very poor growth performance of the last 2 to 3 years. Now, I think obviously yesterday he was at pains to point out how it was factors outside of his control that had led us to that sort of path, and there's certainly an element of truth to that. But I think on the other side of it, you could argue that the government has been a little bit too quick to cut things like capital spending in particular, and they could have gone a little bit more slowly in that. As opposed to, with regards to the length of time it's going to take, the Chancellor seemed to build an extra buffer for himself yesterday on terms of his fiscal mandate. He actually will get there on the OBR's forecast a year early. But what he seems to have done is built in this fact that the OBR have consistently over-forecast the extent to which growth would recover and to which tax revenues would recover. So it looks like he's sort of allowed for that, and this sort of extra buffer he's given himself may mean that even if the forecasts are revised down again in March at the budget time, that he doesn't need to tighten policy again at that point.
Fitch Ratings have since warned that the UK is at risk of losing its AAA credit rating. The OECD recently improved its estimations for growth shrinkage in the UK, and the latest MPC report has suggested moderate improvement in leading indicators. With these, albeit slow signs of improvement, how likely is a Fitch downgrade in your opinion?
I think certainly there are signs that the economy is slowly grinding towards recovery. Even having said that, though, the fourth quarter is still going to be probably at best flat, if not slightly negative, as you get a drag from the Olympic effect disappearing. I think further out, we're still confident that the recovery will start to gain momentum very gradually, and that the public finances will start to improve. But I think the reason that Fitch is so concerned really is the extent to which the debt to GDP ratio is likely to increase over those years. We're still looking at a sort of figure towards the high 70s as a percent of GDP by the end of the forecast horizon. And I think, as Fitch has said, that's getting on for the sort of level where AAA becomes a little bit questionable. I think there is a reasonable chance that the AAA will be lost. Probably 50-50, I would have thought, at this sort of stage. But even if it is, I'm not sure it's the end of the world. I mean, certainly we've seen other countries over the last couple of years, large countries, lose their AAA, and it's had very little impact at all on borrowing costs. And certainly we'd expect the markets to factor that in well ahead of any downgrade actually happening.
That's all for now. I'll be back tomorrow with the weekly wrap-up. Until then, goodbye.